Coming up today, stocks continue to climb as the government shutdown approaches. Will this upset markets? NVDA hits a new record, sports betting stocks get slammed, best performing assets in Q3, and the big risk most investors have without even realizing it. You don't want to miss this one, guys. Let's go. And welcome back, everybody. On the last day of September and the last day of Q3. Just looking at the ETF heat map, was a little mixed across American sectors. Getting a bump up there in healthcare. Also, semis doing well today. International stock markets continuing to perform. Bonds coming off a bit and a little mixed in commodities. But just switching over to a quarter heat map, looking at Q3 performances. It's easy to see the global momentum out there, especially in mining stocks. International stock markets, China perking up. Crypto also finishing higher. And the momentum factor, also the best performing factor this quarter. And to switching over to a year-to-date heat map. Again, momentum well out in front, along with international stock markets. South Korea up 57% year-to-date. And look at that move in gold miners so far this year, 125%. And we've now got the S&P 500, a bit up over 13% year-to-date. Just putting in the second best September in the past 27 years. Very bearish consensus coming into the month, as it's historically the worst performing month, but you'd have to go back to 2010 to get a better performing September. And the market continues to grind higher on low volatility. S&P hasn't finished down one day more than 2% since April. And there has actually been a few more winning streaks in the past 10 years when the market can keep grinding on low volatility for quite some time. And there's a look at the monthly returns for the S&P, just coming in a bit over 3.5%. The last two Octobers were down. You'd have to go back to the late 70s to see 3 Octobers in a row finishing down. And it's quite rare that we see the market peak out in the month of September. And so as we kick off October and Q4 tomorrow, it's normally a very bullish first week, looking back over the last 75 years. In addition to Q4 being the most bullish quarter of the year, well and truly above the 3 other quarters, and typically does well when we've already got a bit of momentum in the market like we do now. But even though Q4 is quite often bullish, we can often see a bit of a consolidation and pullback in October, especially when we're coming in a bit hot like we are now. As for some reason, October is significantly more volatile than other months of the year. And it'll be interesting to see how the market reacts if we do get a prolonged government shutdown. Because right now, looking at the price action in the S&P, the market doesn't seem too worried at all. We're just sitting below all-time highs by a few points, and the VIX index, often referred to as the level of fear in the market, is still quite low, 16.2. The 200-day moving average is at 19.2, and just looking at the VIX 9-day, 13.9 implies option dealers aren't forecasting a lot of volatility over the next 2 weeks. But no doubt there's still plenty of FUD out there, fear, uncertainty, and doubt over this rally, as consumer confidence is still really soft. Just got the latest print today, hitting the lowest level since April, and further signs of weakness in the jobs market, with construction job openings falling to an 8-year low. Something we have seen before going into recessions, and at this stage it seems like a near certainty. The US government will shut down at midnight tonight. Poly market giving it 93% chance that's going to happen. And even though this is normally a nothing burger for the market, as it's always implied, the government will eventually reopen, everything will be okay, we can actually get small positive performance the week after federal government shutdown. So like the market gets worried over nothing, then it gets excited over nothing. However, one top economist says this time could be different. A prolonged government shutdown could derail Fed policy and rattle the markets. That's Mark Zandi, acknowledging previous shutdowns haven't had a significant effect on financial markets, but there are risks this time around, especially if a coming shutdown ends up dragging on longer than others. And I think that's a real risk as well. This one could potentially set a record, both sides digging their heels in, and that could have immediate effects like we may not get the very important jobs report this Friday as regularly scheduled. And since the market's really wondering whether the Fed can continue to ease or not, this jobs report is going to play into that, along with further data prints before the Fed meets on the 29th of October. With the next big one being CPI on the 15th, which could also be delayed if the government is still shut down then. And in another bad sign for the bulls, Jim Cramer just said he doesn't think a government shutdown will have a big impact on the stock market. Hopefully he didn't just jinx us all. And this just comes as Robinhood CEO once again posted today, the bears take the stage, shorting coming to Robinhood, the largest retail broker, now giving investors the option to bet against stocks for the first time. And so even if we don't get these important data prints because the government shut down, it's more an impact on public services. The economy will still operate, and I think the market can continue to price in rate cuts ahead. It's just a matter of how many we're going to get. Looking back in history, following a pause of 6 months or more, when the Fed starts cutting again, if they only cut 2 or less times, that's typically good for the risk-on sectors, tech, industrials, financials. But if they go on to cut 4 or more times, that typically bodes well for the defensives, healthcare, staples, and utilities. And as it stands right now, the market is actually pricing in 4 cut come June next year. So if we are going to get a recession, it should happen at some point in the next 6 months. If we get either a negative Q1 or Q2 2026 GDP print, But for that to happen, we'd really need to see a big pullback in AI headlines and spending. That could cause a recession rather than the recession causing a pullback in AI spending. We just got the biggest stock in the world, closing at a record, hitting 4.5 trillion market cap for the first time ever, after we've had a string of deals over the past few weeks, along with a blockbuster one in OpenAI worth up to 100 billion, causing shares to break out today, closing at 186, quickly approaching $200 for the first time ever. Trailing 12 months PE still not all that crazy at 51 for a company that's still growing more than 50% a year. And we also saw a bump up in CoreWeave, which is the largest position in NVIDIA's stock portfolio, as they just announced a big $14 billion AI cloud infrastructure deal with Meta, just days after expanding their agreement with OpenAI, quickly becoming a key infrastructure company. Obviously, Jensen Huang saw this a while ago, taking a position in the stock last year. And so now CoreWeave's got the biggest tech companies in the world back in it. Really strong price action here on the chart, up another 11% today, causing the entire AI infrastructure sector to have another good day and break out. Looking at the new Tortoise AI Infrastructure ETF. Still very small as it's a young fund, and just looking underneath the hood, quite diversified, and got a bunch of infrastructure stocks, even data center REITs, like Digital Realty Trust, that still haven't quite broken out and gone ballistic yet. Still well off highs. But there are signs of accumulation here on the chart, as the more direct AI stocks continue their uptrend. Looking at the generative AI and technology ETF chat. Another interesting article that popped up on my radar today. Australian homes could soon be built by spider-like robot called Charlotte. The semi-autonomous robot combines robotics with 3D printing, receiving financial support from the government, coming out from a company called Crest Robotics and Earth-Built Technology. They think it could also be used for lunar exploration. And NVIDIA are really trying to get behind the very nascent robotics industry, continuing coming out with new developer tools and building upon their robotics operating system. Also doing a collaboration with Google's DeepMind for an open source Newton physics engine, helping researchers and developers create more capable and adaptable robots, bringing human-like reasoning to robots, allowing them to break down complex instructions and execute tasks using prior knowledge and common sense. We also heard JP Morgan today, the world's largest bank, saying they're dedicated to becoming the world's first fully AI-powered mega bank, just after we heard Walmart say they're not planning to hire any more staff, which I very well think they're actually going to reduce their headcount. They just may be working towards that headline from a public relations standpoint, as they too said they're leaning heavily into AI investment. They're the world's largest retailer and largest employer. Now we've got the world's largest bank saying they've been fundamentally rewired for the AI era. Now early in the next phase of its AI blueprint, it's already begun deploying agentic AI to handle complex multi-step tasks for employees. Already working on their own AI system using models from OpenAI and Anthropic. And so I think it's inevitable. Every company will end up becoming an AI company, with the biggest and the best leading the way. JP Morgan and Walmart currently sitting at all-time highs. Just moving on today, something else that's disrupting companies out there, prediction markets. As I've been saying all year, they've been really gaining momentum, seeing huge growth numbers, and that's because they're just a better product than traditional sports books, which you're playing against the house, most of the time with significantly more unfavorable odds than prediction markets, which operate like a stock market. With a limit order book, you're playing against other players with no limits, with transparent bets running on top of the blockchain, and now the market's starting to wake up to that, with traditional sports betting stocks, DraftKings, and Flutter Entertainment, which own FanDuel, getting slammed down there today after we've been seeing record trading volumes on Kalshi and Polymarket, especially in sports. With the NFL season kicking off, we've also heard Robinhood making moves into the prediction market space, and there's also regulatory tailwinds for prediction markets. There's a look at Flutter Entertainment, off 10% today, and DraftKings as well, down 11.5%. Like I told you guys a few weeks back, I took a bearish options position based on this view, but it actually hit my profit target yesterday, as I shared with my members in the chat room. But nonetheless, still good to see my thesis play out as forecast, and I still think they could have further to go. I wouldn't want to be an investor in DraftKings. They're going to have to really pivot their business, as they've got some serious competition. As more and more players figure out they can get way better odds on Kalshi or Polymarket, there's no limits. They can win as much as they want without their account being shut down. And like I've been saying all year, I think it's inevitable that prediction markets are the future, not only with sports betting, but for all things. Cultural, even betting on what the Fed's going to do. Hedge funds are getting into it, plenty of arbitrage opportunities, hedging, as they're simply becoming too big to ignore. And Kalshi and Polymarket are not yet on the stock market. I wish they were, as I would definitely buy some shares for my long-term portfolio. But I'd say we're very well likely to see them go public and list on the market over the coming year or two. But just moving on to the main topic of this video, and that's most investors are in the dark about this hidden risk, and that's called home bias. And that refers to the tendency for investors to invest the majority of their portfolio in domestic stocks, ignoring the benefits of diversifying into foreign stocks. Now, this was easy to understand why 10, 20, 30 years ago, as it was hard to access foreign markets. Nowadays, of course, it's not, but that home bias is still very much present. In fact, according to Charles Schwab, Americans invest 85% of their portfolios in domestic stocks. And that's because, unfortunately, many people naturally base their expectations off their own experience. Many investors have only been investing through a secular bull market since 2009. They've never really seen a proper bear market or prolonged period of underperformance, which does eventually happen to every market. It's happened many a times, even in the States. The major indices, Dow Jones and S&P 500, went sideways for about 20 years, but a lot worse adjusting for inflation. Someone that was unfortunate enough to retire back in the mid-1960s had a significant portion of their portfolio in US stocks. Adjusted for inflation, saw their purchasing power go down for their entire retirement. Europe as well spent 20 years going nowhere. Investors unlucky enough to get in the market near the highs actually saw big losses. One of the most famous cases of a lost decade, actually ended up being almost 3 lost decades, was Japan, set to overtake the world in the late 1980s. Having the biggest stock market in the world, many people thought they were invincible, only for it to take 30 years to come back to all-time highs. Again, complete retirements were wiped out for those investors with a home bias. But again, there's no excuse for it today. I agree with this article here. Diversification is the only free lunch in investing, and investors around the world are leaving a lot on the lunch table. But nowadays, it's more easier than ever to access the world via ETFs, and that's what some of the wealthiest investors in the world are actually doing, helping to get exposure to not only international stock markets, but commodities, cryptocurrency, strategy-based and thematic funds. And that's because they know that diversification is the key to not only growing wealth, but protecting it. Just looking at the third quarter returns for a bunch of international stock markets, the States came in pretty good at 8.1%, but there were more than a dozen countries that did even better in Q3, including Peru, heavily leveraged to copper, up 26%, and all these countries are available through US-listed ETFs. In addition to nearly all of these commodities available through ETFs as well, and what you'll find in commodity markets is there is a lot more dispersion. Just looking at the returns for September throughout commodities, silver was up almost 15%, while cocoa was down over 12%. It's very, very rare you'll see that kind of dispersion throughout the stock market, when you've got one sector up 15% for the month and another one down 12%. And that's why commodities can provide great diversification in a portfolio, in addition to hedging against an unknown future. No doubt American stocks are on fire. They could very well keep going for another year or two. Nobody knows exactly when the top will come. I'm almost certain that we're already in, or we're about to go into an AI bubble that could be one of the most epic bubbles of our lifetime. No doubt there's a lot of money to be made on the way up, but you can rest assured many investors, hedge funds, and entire companies will inevitably blow up when the music stops, just like it did back in the late 90s. And we've now got the US total market cap to GDP at an all-time record 218%. And that's Warren Buffett's favorite valuation tool for the entire stock market. So it's no surprise to see Buffett and his company, Berkshire Hathaway, sitting on a record pile of cash, $344 billion. No other company in the world has more cash on their balance sheet than Warren Buffett's does. He may be early, but I do think he will inevitably end up being right, like he normally is. And that's because he's been around long enough to know that markets go through cycles, booms and busts. They always get carried away and normally overshooting in both directions. With the US Shiller PE, Cape ratio, 10-year price to earnings, now approaching 45, close to where it reached in the late 90s, and much of the rest of the world is still around average valuations, some of them even cheap, and even Buffett himself, who's probably one of the most patriotic investors to ever live, has been diversifying his portfolio not only into cash, but himself has been actually buying some international stocks these last few years in Brazil, in Switzerland, and Japan, as he's seeking to protect his investors' money, just as I'm doing the same myself. And that's a big reason why I created my ETF portfolio strategy, is to protect and grow my own wealth without being too over-reliant on any one country, just because I live there or it's the biggest in the world. And so I think most investors are in the dark about this hidden risk. In addition to being employed or having a business in their own home country, they've also got property and local stocks and funds. Many investors have 80% or more of their wealth completely leveraged to just one country because they happen to live there. Now, there's nothing wrong with being a little patriotic and always having some local assets, but I think a lot of people don't realize how much risk they're really carrying by having 70, 80% or more of their entire wealth leveraged to one country. Because if their country's unfortunate enough to have a lost decade or two, like I said, it's wiped out entire retirements before. Even if the market goes sideways, inflation eats your purchasing power. Your bills never stop going up, but your income can. And so that's why I created this ETF portfolio strategy. It forces global diversification, always giving me an exposure to securities from all around the world across different sectors, different asset classes, and different themes. Using the momentum strategy, it always rotates out of weakness into strength by being completely country agnostic and letting the trends determine my holdings, not my biased views or trying to guess what's going to perform well next. And so I'm about to kick off this strategy starting tomorrow. I've put $100,000 of my own money behind it, and I'm about to buy 10 ETFs in the market tomorrow, the 1st of October. Rebalancing the portfolio on the first trading day of every month, typically selling a few ETFs and replacing them with some new ones, according to my unique momentum formula. And so if you'd like to jump on board and follow my real money portfolio, getting all my trades the day before I make them, along with access to the private members area, then click the link below this video, visit my website clickcapital.io and use promo code ETF40 at checkout to lock in your permanent 40% discount before it expires this weekend. I truly believe in this strategy and I've committed to running it for the rest of my life, as I believe it's the best way to protect and grow my family's wealth, not being too reliant on any one country or sector, as we're all naturally overexposed to our own home countries. And so if that all makes sense to you and you want to jump on board, now's the time to do it. The first monthly report's already gone out to members tonight, but it's not too late. You can get in and see inside the members area what 10 ETFs I'll be buying tomorrow. Just click the link below this video and use code ETF40 at checkout, and you can start following this strategy with me from today. That's all for now. Thanks very much for watching, and I'll be back again this time tomorrow. Cheers.